Take a look at this chart. It shows us how much institutional capital is flowing into or out of Ethereum. When the bars are rising, it means money is coming in. And when it's falling, then capital is being pulled out. Now look at what just happened recently. Institutions poured $750 million into Ethereum in a single day. That's the largest inflow we've seen since July of 2024. And it's nearly double the previous highest inflow we saw back in December of 2024. This surge of institutional buying has already sent Ethereum's trading volume soaring. But it's not just Wall Street making moves. As we'll show you in this video, there is another major buyer stepping in, one that has already bought up billions of dollars worth of Ethereum in just the last 2 months, with plans to buy billions more. And if this pace of accumulation continues, Ethereum may be headed straight into a massive supply squeeze. The reason behind the rise in demand that we're seeing today becomes clear when we look at the potential impact Ethereum can have on traditional portfolios. This chart shows the impact of adding just a 5% Ethereum allocation to a classic 60/40 portfolio, measured over a 3-year time frame. This line here represents the baseline portfolio without Ethereum, and the green area shows the additional return generated by that 5% Ethereum exposure. What stands out is the consistency. Even at the low end, the added return has been around 0.01%, despite Ethereum's volatility. On average, it's been slightly over 17%, and in some cases, it's gone as high as 73%. Now, of course, this is measured over a 3-year span, so results can still vary from year to year. But over time, Ethereum has shown that even a small allocation can significantly boost portfolio returns. And that outperformance becomes even more compelling when we add in the full portfolio stats. This table breaks down the performance of a traditional 60/40 portfolio compared to one with a small Ethereum allocation. Even with just 5% exposure, the annualized return, which tells us the average yearly return, jumps from 7% to 16%. Now yes, adding Ethereum does increase portfolio volatility from 9% to almost 13%, and it also raises the maximum drawdown from 22% to 25%. So basically by 3%. But that trade-off has historically been more than worth it, because the boost in return more than outweighs the small added volatility, or in other words, the reward outweighs the risk. And we can see that by looking at the cumulative returns, which shows the total gain over the entire period. Adding Ethereum more than triples this number from 77% to 240%. So this attractive risk-reward potential is a big reason why investors are loading up on Ethereum. And believe it or not, a key reason it's happening right now has to do with stablecoins. Stablecoin adoption has exponentially grown over the past few years. We can see that through this chart showing the total volume of stablecoin transactions, so basically the usage. Back in the second quarter of 2020, only $100 billion worth of transactions occurred through stablecoins. By the second quarter of 2023, that number rose to over $2 trillion. And recently, in the second quarter of 2025, it has shot up to $7.5 trillion. That's a 75-fold increase in only 5 years, and we think this growth is set to accelerate even further because of the Genius Act, which aims to establish a regulatory framework that fast-tracks stablecoin integration into the mainstream financial system. You see, compared to traditional bank transfers, stablecoins settle in under 10 minutes instead of 1 to 5 business days, cost less than $1 per transaction, versus over 1.5% for credit cards, and operate 24/7 instead of just during banking hours. And now, with this Genius Act legislation in place, it could prove to be the catalyst that drives the stablecoin market significantly higher. We're already seeing early signs of this playing out in the market. This chart shows the total market cap of all the stablecoins in circulation. Since 2024, the stablecoin market has gone from $130 billion to $260 billion. So doubling in size in just 1.5 years, and this is likely just the beginning. U.S. Treasury Secretary Scott Bessent projects the stablecoin market cap to reach $3.7 trillion by 2030, which would be an increase of nearly 1,500% from current levels. This matters a great deal for Ethereum, and we can see why through this chart showing where stablecoins are actually hosted. Right now, Ethereum accounts for just over 50% of all stablecoins in circulation. That's about $130 billion out of the total $260 billion. The next closest network is Tron, which holds roughly 30%. This dominance makes Ethereum the leading infrastructure for stablecoins and uniquely positioned to capture a large share of the growth ahead. As stablecoin adoption accelerates, it means more transactions, higher fees, and greater demand for Ethereum's network, which ultimately drives more demand for the Ethereum token itself. So, if stablecoins become more widely adopted under clear regulation by the Genius Act, Ethereum stands to benefit both in usage and in valuation. And institutions are already positioning themselves for this potential growth on Ethereum. But it's not just institutions loading up on Ethereum today. There's another powerful buyer that has recently entered the market, and they're accumulating at an unprecedented pace. These are known as Ethereum Treasury companies. They consist of firms that hold Ethereum on their balance sheets as a strategic reserve, much like Bitcoin treasury companies like MicroStrategy do with Bitcoin. As of July 2025, there are about 12 publicly listed Ethereum treasury companies, with Bitmine Immersion Technologies currently holding the largest position. Since the start of June, Bitmine has already acquired over 1.5 million Ethereum tokens, totaling nearly 1.25% of the total supply, and they've made it clear that their long-term goal is to secure as much as 5% of the entire Ethereum supply. There's also SharpLink, the second biggest Ethereum treasury company that's already accumulated nearly 750,000 Ethereum coins. That's almost 0.62% of total Ethereum supply in just 2 months, and they have already raised another $537 million to buy more Ethereum tokens. So together, Bitmine and SharpLink have already bought up nearly 2% of all the Ethereum in circulation in about 90 days. This surge in demand from Ethereum treasury companies is setting the stage for what's known as a supply squeeze. In simple terms, a supply squeeze happens when available supply for an asset dries up while demand keeps rising, which typically pushes prices sharply higher, and we're already seeing signs of it. Wintermute, one of the largest market makers, has said they have almost no Ethereum left for over-the-counter sales. If these treasury companies keep buying at the current pace and new ones continue to emerge, the upward pressure on Ethereum's price could become even more significant. According to a recent study, it takes around $135 million of capital to move Bitcoin's price by just 1%. Ethereum, however, is roughly twice as price sensitive. That means it would take less than $70 million to push Ethereum up by 1%. From current levels, it would require a little over $1 billion to push Ethereum up by 15% and reach new all-time highs. Now, of course, this is a theoretical scenario because it assumes that the entire amount hits the market all at once. But it does highlight the impact that institutional demand combined with aggressive buying from Ethereum treasury companies could have in driving a supply squeeze and sending Ethereum to new highs. And in this crypto bull run, we believe that scenario is well within reach. However, in the near term, Ethereum could continue to consolidate after a 40% rally just this month alone. That's why we booked profits of 21% on our Ethereum position on the website. Over the past year, we've had multiple successful trades on Ethereum, with gains like 28%, 37%, and even 83%, and the few that didn't work out were all closed with losses of less than 5%. If you want to follow our trading strategy step by step with real-time buy alerts, sell signals, and portfolio updates, make sure to subscribe to our service using the link below.